I remember very well the 2008 bear market because I came into it with a reasonable amount of cash and I'd seen panics before. So I had the tools and I had the courage to pull the trigger. I'm not trying to, I've got them all right, by the way. But 2009 was very, very good to me.
Rick Rule emphasizes that recessions, though often viewed negatively, serve a crucial purpose in correcting mistakes made during booms. He attributes the cyclical nature of the economy to government interference, particularly in manipulating interest rates, rather than inherent flaws in capitalism. Rick suggests that the current delay in a recession is due to unprecedented fiscal stimulus, with substantial government spending and deficits temporarily propping up economic growth. However, he warns that this delay cannot last indefinitely. The massive accumulation of debt during this period, despite the apparent economic growth, poses a significant risk. When the recession eventually hits, the impact is expected to be more severe due to the accumulated debt burden. In the context of holding cash, Rick Rule's insights imply a cautious approach. While the current economic landscape may seem stable, the looming threat of a significant recession suggests that holding cash could be a prudent strategy. This approach aligns with the anticipation of market corrections and economic challenges, allowing investors to capitalize on opportunities that may arise during the downturn. With that, let's dive into his thesis. Also, make sure to hit the like button, subscribe, and drop your comments below.
So people like you and me, at least, our lifestyles, as people can see by our backdrops, are pretty good. Mm-hmm. And if my gold didn't go up in price and my lifestyle didn't change, I'd be happy about that. It's interesting, too, when I look at the comments around our interviews, and people who own gold for a different reason say, well, the price hasn't gone anywhere. And that reflects a recency bias. If you look back, as an example, to the year 2000, gold was at $256. Now gold is flirting with $2,000. That's my kind of motionless market. It has done very well. It hasn't reflected very many people's time preference. But again, from my point of view, the essence of a good investment is one where time is on your side, where time does well. Compounding is what made me, a complete novice in real estate, do extraordinarily well. It wasn't like I bought something for $1 million and immediately sold it for $1,275,000 or something like that. That isn't what happened. What happened was that I owned it long enough that inflation raised the cost of somebody being able to compete with me. The rents increased. The cost of capital stayed steady, in fact, decreased. It was time that made me seem smart as a real estate investor. And I'm afraid it's going to be time that makes me seem smart as a bullion holder. Certainly in the rest of my portfolio around conventional financial services. As an example, owning an insurance company or a bank that serves its business well, time, that compounding is what makes you wealthy. With oil stocks, time is what makes you money. I think if we get nothing else across in this interview, it's that you need to invest while time is on your side. I was told once, talking to older investors when I was still a stockbroker, I was told by a gentleman who was in his late 70s, he said, you tell those codgers when they tell you that they don't buy green bananas, that next week they aren't going to have any bananas. The truth is that what's happened to me is when I was young, I was very impatient. It isn't that my time preference has changed. It's just that I've learned that my preferences don't matter at all. I've become more patient because I've learned it takes 5 or 6 years or 10 years, irrespective of how long I thought it might take. What it does take is fairly extended periods of time. So ironically, now that I have time left on Earth, I'm more patient. I think that is an important thing. It reminds me of driving, I guess it probably would have been late 2006, maybe early 2007, driving the 405 freeway, which you'd be very familiar with, northbound from San Diego. And as I say, I'm not a real estate guy, but on the right-hand side of the 405, there was a great big billboard, an outdoor advertising thing.
Uh-huh.
And, I've been a lender most of my life. And the billboard said, borrow 125% of the value of your house. Bad credit, okay. It said, bad credit, okay. And I remember thinking, I don't think that's going to work out for somebody. Well, I'll tell you, it did bother me. Now, I wasn't a big real estate investor, and I wasn't a big real estate lender. What I was a shareholder in a couple of banks that were pretty good size in mortgage financing. I wasn't smart enough to go short, but I was smart enough to get that part of my money out of harm's way. The other thing that you said that's really interesting to me has to do with these declines. Buffett has observed that in his life, every 10 or 15 years, something happens, a panic that changes general pricing levels. Both Buffett and Doug Casey, obviously polar opposites in many ways, both of them have observed that bear markets don't make assets worth less. They make them sell for less, and they make them change hands. They go from weak hands to strong hands. Now, the weak hands don't like that a bit, but I think if you conduct your life with the understanding that Buffett has, that every 10 or 15 years, general price levels around investments are going to fall by half. And if you keep some powder dry, and if you try to participate, A, in assets that are out of favor, but B, in assets that are fundamentally mispriced, not assets that are underpriced relative to the expected, means or norms, that while you probably won't do as well as Buffett, that's probably asking more than you should. You will do fine. I remember very well the 2008 bear market because I came into it with a reasonable amount of cash, and I'd seen panics before. So I had the tools and I had the courage to pull the trigger. I'm not trying to, I've got them all right, by the way. But 2009 was very, very good to me. And my own suspicion is that sometime in the next 5 years, I'm likely to get another opportunity like that. I hope I don't, but I think I will. That's one of the reasons why I ask people to have cash, despite the fact that the interest that you get paid on your cash is destructive of capital. If you think about the delta between the deposit interest rate that you get paid and the real depreciation of your currency, and you understand that savings actually cost you money, you have to have savings anyway, because that delta really is an option premium on having the liquidity to take advantage of an illiquid market rather than being taken advantage of by that same market.
Today, we delved into an insightful discussion with Rick Rule, shedding light on the dynamics of economic booms and busts. Rick emphasized the crucial role of recessions in correcting mistakes made during booms, challenging the perception that these cycles are inevitable consequences of capitalism. He pointed to government interference, especially in manipulating interest rates, as the root cause. As we navigate through these economic complexities, Rick highlighted the current delay in the onset of a recession, attributing it to unprecedented fiscal stimulus. However, he cautioned about the risks associated with the massive accumulation of debt during this period, signaling that a significant recession could be on the horizon. We hope you found today's insights valuable. If you enjoyed this content, don't forget to subscribe, like, and hit the notification bell to stay updated on our latest discussions. Your opinions matter, so feel free to share your thoughts in the comments section below.